We are taught that central banks stabilize economies, that the Federal Reserve was created to prevent financial panics, that monetary policy protects against depressions. But this is the version they teach in economics courses to maintain the illusion of competent central banking. The truth is that in 1928 and 1929, the Federal Reserve raised interest rates to stop stock speculation, and the policy they implemented triggered the worst economic disaster in modern history. This killed 9,000 banks and destroyed the American banking system. This is the story of how the Fed created the Great Depression. To understand what happened in 1929, you need to understand the man who prevented it from happening earlier. Benjamin Strong joined the Federal Reserve Bank of New York as its first governor in 1914. For 14 years, he was the most powerful central banker in America. He understood that central banks can stabilize or destabilize economies. During the Roaring Twenties, industrial production soared. Automobiles, radios, refrigerators. The stock market reflected this prosperity. Strong managed monetary policy carefully. When the economy slowed, he lowered rates. When it accelerated, he raised them modestly. He understood the Fed's job was stable money and credit, not micromanaging the economy. And critically, he understood the gold standard constraints. In 1925, Britain returned to gold at pre-war parity. This overvalued the pound. Strong kept American rates lower to ease pressure on sterling. Many criticized this. Herbert Hoover believed Strong was fueling credit inflation and stock speculation, but Strong believed the Fed should not target stock prices, focus on real economic activity and money supply. If stocks rose from genuine growth, healthy. If from excessive speculation, address it through direct regulation, not by crushing the entire economy with high rates. On October 16, 1928, Benjamin Strong died. He was 55 years old. His death left a power vacuum at the Federal Reserve. The New York Fed, which Strong had dominated, lost its preeminence. The Federal Reserve Board in Washington, led by men who disagreed with Strong's philosophy, gained influence, and the Open Market Committee, which controlled monetary policy, came under the control of officials who held very different views. Adolph Miller, a professional economist on the Federal Reserve Board, had disagreed with Strong for years. Miller believed that the Fed had been too easy during the 1920s, that low interest rates had fueled the stock market bubble, that it was the Fed's duty to deflate the bubble. Charles Hamlin, another board member, shared Miller's views. After Strong's death, these men gained control of monetary policy, and they implemented a policy that Strong would never have approved. Starting in January 1928, even before Strong's death, the Fed began raising interest rates. Between January and July 1928, the discount rate rose from 3.5% to 5%. Because nominal prices were falling slightly, this translated to a real discount rate of 6%. This is extraordinarily high in a year following a mild recession. At the same time, the Fed sold government securities on the open market. This drained reserves from the banking system. According to economic historian James Hamilton, the Fed sold more than 3/4 of its total stock of government securities. In his words, it would have been difficult to design a more contractionary policy. The stated reason for this tightening was to curb stock market speculation. Loans to stockbrokers were growing. Margin debt was rising. The Fed believed that by raising rates, it could make it more expensive to borrow for speculation. But monetary policy does not work like a scalpel, it works like a sledgehammer. When the Fed raises interest rates, it affects all borrowing, not just stock speculation. Construction companies planning new buildings face higher costs. Automobile manufacturers financing expansion see their projects become unprofitable. Farmers borrowing for equipment find loans unaffordable. By mid-1928, the contractionary policy was already slowing the economy. Industrial production began to decline. Housing construction, which had been a major driver of growth in the mid-1920s, collapsed. Automobile purchases fell. Employment weakened. By the summer of 1929, the economy was already in recession. The stock market, meanwhile, continued to rise through September 1929, because investors did not yet realize how severe the economic slowdown would become, and because margin lending, despite the Fed's efforts, remained high. Banks found ways around the Fed's restrictions. Non-bank lenders filled the gap. This created a dangerous situation. The real economy was contracting. Corporate profits were falling. But stock prices, driven by speculation and borrowed money, kept rising. The gap between fundamentals and valuations grew wider. By October 1929, stocks were trading at levels that could not be justified by any reasonable expectation of future earnings, and then the bubble burst. On October 24, 1929, Black Thursday, panic selling began. Many stocks had been purchased on margin, using loans secured by only a small fraction of the stock's value. As prices fell, margin calls forced investors to liquidate holdings. This drove prices down further. More margin calls, more forced selling. Between their peak in September and low in November, stock prices fell 33%. This was the Great Crash. But the crash did not cause the depression. It was a symptom of the underlying contraction that Fed tight money had created. By November, industrial production had been falling for months. Construction was collapsing, unemployment rising. The stock crash made things worse by destroying wealth and confidence. But the recession had already begun. Under Strong, the answer would have been obvious. Ease policy, provide liquidity. But Strong was dead. The men controlling policy believed the stock bubble needed liquidation. This was liquidationist view. Let bad investments fail, let speculators lose money. Treasury Secretary Andrew Mellon summed it up. Liquidate labor, liquidate stocks, liquidate farmers, purge the rottenness. The Fed did nothing. Throughout 1930, as the economy contracted, the Fed maintained tight money. When New York Fed proposed buying securities to inject liquidity, the board blocked them. Several members felt investment was fundamentally unsound. Others feared monetary expansion would reignite speculation. Better to let recession run its course. And then in November 1930, something happened that turned a recession into a catastrophe. Banks began to fail. Not a few banks, hundreds of banks. The first wave started in Nashville, Tennessee. Caldwell and Company, a large financial conglomerate, collapsed. This triggered runs on banks throughout the Southeast. Depositors, fearing their banks might fail, rushed to withdraw cash. Banks, which typically hold only a fraction of deposits as cash reserves, could not meet this sudden demand. They were forced to sell assets at fire sale prices to raise cash. These losses made other banks look insolvent, which triggered more runs, which forced more asset sales, a vicious cycle. And the Federal Reserve, which was created specifically to prevent such panics, did almost nothing. The Fed did provide some emergency lending in November and December 1930, but it was modest and temporary. As soon as the immediate crisis passed, the Fed resumed its contractionary stance. Throughout 1931 and 1932, banking panics continued. Each wave was worse than the last. In December 1931, the Bank of the United States in New York collapsed. Despite its name, it was not a government institution, but it was the largest bank failure in American history at that time, with over $200 million in deposits. When officials at the New York Fed proposed more aggressive action, they were blocked by the board in Washington. Why? Several factors paralyzed Fed policy. First, the gold standard. The U.S. remained on gold. Any monetary expansion risked gold outflows. Under gold standard rules, the Fed had to maintain gold backing. In September 1931, Britain abandoned gold. This pressured the dollar. Investors converted dollars to gold. The Fed's reserves fell. In response, the Fed raised interest rates. In the middle of a depression with banks failing and unemployment soaring, the Fed raised rates to defend gold. This was the second grave mistake. By early 1932, industrial production had fallen 47%. Unemployment reached 25%. Farm incomes collapsed. Foreclosures swept rural America. And the banking system continued disintegrating. By end of 1932, more than 5,000 banks had failed. Deposits frozen, credit dried up, money supply contracted 30%. In February 1933, the final nationwide banking panic began. On March 4, Roosevelt was inaugurated. On March 6, he declared a national bank holiday. Every bank in America was ordered closed. Roosevelt's treasury examined every bank. Those deemed solvent reopened. Those deemed insolvent were liquidated. By the end, 14,000 banks remained. About 10,000 had disappeared. Roughly 9,000 failed outright. From 24,000 banks in 1929 to 14,000 in 1933, nearly half eliminated. Depositors lost over $7 billion. In today's money, about $150 billion. When banks fail, credit disappears. Businesses cannot borrow. Farmers cannot get loans. Construction is abandoned. Even remaining banks stop lending. Economic activity spirals downward. And here is what makes this tragedy so frustrating. It was preventable. The Federal Reserve was created in 1913 with one primary purpose: to serve as lender of last resort during banking panics, to provide liquidity to solvent banks facing temporary withdrawals. Benjamin Strong understood this. He had worked closely with J.P. Morgan during the Panic of 1907. He knew how banking panics worked. Had Strong lived, he almost certainly would have responded differently. He would have provided massive liquidity during the 1930 panic. He would have prevented the subsequent waves. He would have eased policy aggressively to offset the monetary contraction. The Depression might have been no worse than the recessions of 1920 or 1924. But Strong died, and the men who replaced him did not understand monetary policy, or they understood it but chose wrong priorities. They prioritized defending the gold standard over preventing bank failures. They prioritized liquidating speculation over maintaining employment. They believed recessions were necessary corrections, that government intervention would only make things worse. In 1963, Milton Friedman and Anna Schwartz published A Monetary History of the United States. They documented how Fed policy caused the Depression. The money supply contracted 31% between 1929 and 1933. the largest monetary contraction in American history. This resulted from Fed policy choices: tight money in 1928 and 1929, failure to provide liquidity during panics, raising rates in 1931 to defend gold. Each made the depression worse. Gradually, economists accepted the Friedman-Schwartz view. By 2002, even Fed officials acknowledged it. Bernanke, then a Fed governor, gave a speech honoring Friedman's 90th birthday. His conclusion was stunning. Regarding the Great Depression, "You're right, we did it, we're very sorry, but thanks to you, we won't do it again." A sitting Fed official admitting the Fed caused the worst economic disaster in history. In 2008, Bernanke was Fed chairman. He implemented massive expansion, provided unlimited liquidity. He likely prevented another Great Depression. But the 1929 disaster started with the decision to raise rates to curb stock speculation. This reveals a fundamental problem. When central banks target asset prices, they risk destroying the real economy. Stock prices were rising. Some was speculation. Much was justified growth. The Fed could not distinguish, so it crushed both. The gold standard made things worse. It forced countries to defend gold reserves rather than their economies. When the Fed tightened, other countries had to tighten or risk losing gold. The gold standard transmitted depression globally. About 36 countries were trapped. Those that abandoned gold earliest, like Britain in 1931, recovered quickest. Those that clung to gold longest suffered most. But the gold standard was not the fundamental problem. The fundamental problem was the belief system that dominated central banking, the liquidationist philosophy, the real bills doctrine, the idea that credit should only finance productive investment, not speculation. These beliefs led Fed officials to believe that monetary contraction was necessary, that liquidation was healthy, that preventing this would only delay recovery. Benjamin Strong opposed these views. He believed in using monetary policy countercyclically, ease in recessions, tighten in booms, focus on maintaining stable employment and price levels. Do not try to micromanage credit allocation or asset prices. His successor at the New York Fed, George Harrison, tried to continue Strong's approach, but he lacked Strong's authority. The board in Washington blocked his initiatives. If you read the minutes of Federal Reserve meetings from 1930 to 1932, you see Harrison repeatedly proposing open market purchases, and you see board members repeatedly rejecting them. The reasons vary: worry about gold reserves, fear of reigniting speculation, belief that liquidation was necessary. But the effect was the same. Monetary policy remained tight as the economy collapsed. By 1933, the damage was irreversible through monetary policy alone. The banking system was destroyed. Trust was shattered. Even when Roosevelt provided massive liquidity after the bank holiday, recovery was slow. The economy did not return to 1929 output levels until the early 1940s. Full employment did not return until World War II created massive government spending. The Great Depression proved that central banks can destroy economies, not through malice, through mistakes, through bad theory, through prioritizing the wrong objectives. The 9,000 banks that failed did not fail because they were poorly managed. Most were solid institutions that had made reasonable loans. They failed because the Fed allowed the money supply to collapse, because depositors panicked when they saw other banks failing, because the Fed did not act as lender of last resort. Each bank failure destroyed credit relationships. Local businesses that had banked there for decades suddenly had no access to credit. Farmers who had borrowed for spring planting could not get loans. Workers lost their savings. Confidence eroded further. More banks failed. The spiral continued. And through it all, the Federal Reserve watched and did nothing. The men who controlled Fed policy from 1928 to 1933 were not evil. They believed they were doing the right thing. They believed that easy money had caused the bubble, that tight money was the cure, that allowing liquidation would cleanse the economy. They were wrong, catastrophically wrong. The lesson should have been clear. Central banks must prioritize economic stability over other objectives. They must act as lender of last resort during panics. They must not use tight money to fight asset bubbles. The cost of crushing speculation is crushing the economy. But this lesson keeps being forgotten. In the 1970s, the Fed allowed inflation to spiral. In the 2000s, the Fed kept rates too low and allowed a housing bubble. In 2008, some initially called for letting banks fail to punish reckless lending. Only Bernanke's memory of the Great Depression prevented that mistake. He understood that bank failures are contagious, that letting Lehman Brothers fail would trigger a cascade. He was proved right. Lehman's failure caused panic. Only massive intervention prevented catastrophe, but even Bernanke could not prevent the Great Recession. The 2008 crisis caused enormous damage. Millions lost homes. Unemployment soared. Recovery took years, which raises a question. If we know what caused the Great Depression, why do financial crises keep happening? Why do central banks keep making mistakes? Because monetary policy is difficult. Because the economy is complex. Because central bankers are human and make errors. But also because of the fundamental problem with central banking itself. Central banks have enormous power. the power to create or destroy money, to make credit abundant or scarce, to inflate or deflate asset prices. This power is necessary. Modern economies need central banks, but concentrating such power in the hands of a few officials is dangerous, especially when those officials believe they know better than markets, when they think they can fine-tune the economy, when they prioritize fighting bubbles over maintaining growth. Benjamin Strong understood the limits of central bank power. He focused on keeping money and credit stable, not on micromanaging the economy. His successors forgot this wisdom. They believed they could burst the stock bubble without harming the real economy. They were wrong. The stock crash of 1929 was painful, but it need not have led to depression. The depression came from the monetary contraction, from the Fed's failure to prevent bank failures, from the decision to prioritize gold over employment, from liquidationist philosophy run amok, and the result was 9,000 failed banks, 25% unemployment, a decade of suffering, political upheaval that brought Hitler to power in Germany and threatened democracy globally. This is what happens when central banks fail. Not gradual decline, catastrophic collapse, the destruction of wealth on an unimaginable scale, social and political chaos, war. The 1929 mistake did not just cause economic hardship, it changed world history. And it all started with a decision to raise interest rates to fight stock speculation. The lesson is stark. Monetary policy is powerful. Too powerful to be used carelessly. Too important to be based on untested theories. The Federal Reserve was created to prevent panics. In 1928 to 1933, it caused one. Benjamin Strong knew how to prevent this. His successors did not. That is the story of how the Fed created the Great Depression, not through intention, through error, and how one man's death left a power vacuum that allowed disaster. 9,000 banks failed, millions suffered, all because the Federal Reserve raised interest rates to stop stock speculation and then refused to ease as the economy collapsed. The 1928 rate hikes were supposed to prevent a crisis. Instead, they triggered the worst crisis in modern economic history. The mechanism was simple: tight money, recession, stock crash, banking, panics, monetary contraction, depression. Each step made the next inevitable. And through it all, the Fed watched and did nothing because they believed doing nothing was the right policy. That liquidation was healthy. That intervention would only make things worse. They were wrong. And 9,000 banks paid the price.